A few years ago, imagine an American investor named Michael sitting at his kitchen table looking at his investment account. He wasn't picking individual stocks. He wasn't trying to beat Wall Street. He had done what everyone told him to do. He bought ETFs. One for the S&P 500, one for technology, one for dividends, and one international fund for diversification. Michael looked at the list and felt something most investors want to feel: safe, diversified, simple. But then he asked a question that almost nobody asks when they first build a portfolio. How different are these investments, really? Because the strange thing about ETFs is that they can look completely different on the outside, while quietly doing very similar things underneath. And sometimes your ETF may be doing something you never expected. Not necessarily something bad, not necessarily something dangerous, but something that can completely change what you think you actually own. And the first surprise starts with a word investors hear all the time: diversification. Never put all your money in one stock. It sounded obvious, so Michael bought an S&P 500 ETF, then a technology ETF, then another fund focused on large American companies. He thought he had spread his risk across hundreds of companies. But here's where the story gets interesting. Buying several ETFs doesn't automatically mean you've built several independent investments. Two different ETFs can own many of the same companies. And if those companies make up a large portion of the funds, you may have more exposure to them than you realize. Think about walking into a grocery store with 3 different shopping lists. One list says fruit, another says breakfast, another says healthy foods. The lists look different. But if all 3 tell you to buy apples, you didn't really buy 3 different things. You bought a lot of apples. The same basic idea can happen inside an ETF portfolio. And this matters because the ETF label can make diversification feel larger than it actually is. You may own 5 funds, but your money could still be heavily connected to the same group of companies, industries, or economic trends. That doesn't automatically make the portfolio bad. It simply means the label on the ETF isn't enough. You have to look underneath it. And this becomes even more important because ETFs have changed dramatically. They aren't just simple index funds anymore. The US ETF market has grown into a massive industry. By May 2026, US ETFs held about $15.6 trillion in assets across 4,873 funds. That's thousands of different ways for investors to package stocks, bonds, commodities, strategies, sectors, themes, and other exposures into something that trades throughout the day. And that creates a strange situation. The easier ETFs become to buy, the easier it becomes to forget to ask what is actually inside them. Imagine Michael's father had spent most of his investing life buying broad market funds. He understood the basic idea: buy a diversified fund, keep costs low, hold for the long term. But his son started seeing ETFs with names built around technology, artificial intelligence, income, energy, specific industries, and even individual companies. The word ETF made them all sound like members of the same family. They weren't. Some ETFs are designed to track broad indexes. Others concentrate on specific sectors. Others use derivatives. Some pursue leveraged daily returns. Some use option strategies. Some can trade at prices above or below the value of their underlying holdings. And this is the part investors often miss. ETF describes the structure. It does not tell you exactly what the investment is doing. That's like saying you bought a car. That tells you almost nothing about whether you bought a family sedan, a pickup truck, or a race car. The structure is one thing, the strategy is another. And once you understand that, you start seeing the ETF world differently. Because your ETF isn't just a basket sitting quietly in your account, it is a financial machine. And what that machine does depends on what it was designed to do. Which brings us to the second surprise. Sometimes the ETF's price isn't exactly the same as the value of everything inside it. That sounds strange, but it can happen. An ETF trades on an exchange during the day. Its market price can temporarily move above or below its net asset value, or NAV. The sexinvestor.gov explains that investors can sometimes pay more or less than the value of the underlying assets when buying or selling an ETF. Usually, the difference is kept relatively small through the ETF's creation and redemption mechanism. But small differences can still matter, especially when markets become stressed. and there's another number sitting quietly between the price you see and the price you actually get. The bid-ask spread. Imagine your grandfather had bought an investment without realizing there were effectively two prices in the market. One price is what someone is willing to pay, the other is what someone is willing to sell for. That gap is the spread. With a highly liquid ETF, the gap may be tiny dot. With a less liquid product, it can become wider, and when you trade, that difference can become a real cost. So now we have something unexpected. Your ETF can be diversified. While overlapping with another ETF, it can be inexpensive, while still creating trading costs. And it can trade throughout the day, at a price that isn't always identical to the value of the assets underneath. But that's still not the biggest surprise. Because there is one category of ETF where the word long-term can become especially important, and if an investor misunderstands one tiny word in the fund's objective, the results can be completely different from what they expected. That word is daily. Imagine your uncle sees an ETF promising 2 times the daily return of an index. The market is going up, the chart looks incredible, and he thinks, if the index goes up 10%, I'll make roughly 20%. At first glance, that sounds reasonable. But there's a word hiding in that sentence: daily. A leveraged ETF designed to provide 2 times the daily performance is generally resetting that exposure each trading day. It isn't simply promising you 2 times the index's return over whatever period you happen to hold it. And that distinction can become extremely important when markets move up and down. Imagine an index starts at 100. One day it rises 10%, now it's 110. The next day, it falls 9.09%. It returns to 100. The index has essentially gone nowhere. But a hypothetical 2 times daily leveraged product would experience approximately plus 20% on the first day and minus 18.18% on the second. Starting with 100, it would end around 98.18. The underlying index is back where it started. The leveraged product isn't. That's not a glitch. That's a consequence of daily compounding. And it reveals something important. An ETF can be doing exactly what its prospectus says, while producing a result that an investor never expected. This is why the name on an ETF is never enough. You have to understand the objective. How does it achieve that objective? What does it hold? How often does it rebalance? What happens when markets become volatile? And what kind of investor was the product actually designed for? This matters even more now because the ETF industry isn't standing still. New ETF structures continue to appear. In 2026, the SEC has been examining novel ETF products and the implications of new structures as the industry continues to expand. The chairman of the SEC noted in May 2026 that ETF assets had tripled since 2019 and that new products were raising new questions. That's an important signal. The ETF isn't disappearing. It's becoming more sophisticated, and sophistication can be useful, but sophistication can also create complexity. Now go back to Michael. He owns 3 ETFs. He checks the names, everything looks diversified. But when he opens the holdings, he notices something. The same giant companies appear again and again. One fund owns them because it tracks the broad market. Another owns them because it focuses on technology. A third owns them because it targets large-cap growth. Michael suddenly realizes something. He wasn't just buying different funds, he was repeatedly buying the same economic story. And this is where ETF diversification becomes a psychological issue. Humans tend to trust categories. If something has a different name, we naturally treat it as different. Large cap ETF, technology ETF, growth ETF, dividend ETF, international ETF. Different labels create a feeling of separation, but your portfolio doesn't care about the labels. Your portfolio cares about the actual holdings and the risks connecting them. That's why 2 funds can behave very differently in calm markets, and suddenly move together when the environment changes, because the companies inside them may be responding to the same interest rates, the same economic slowdown, the same technology cycle, or the same investor enthusiasm. This doesn't mean broad ETFs are secretly bad, quite the opposite. Many ETFs can be useful tools for diversification and low-cost investing. The SEC notes that ETFs can offer benefits, such as relatively low expenses and in many cases, tax efficiency. But it also warns that ETFs carry risk, can trade at premiums or discounts to NAV, and have trading costs such as bid-ask spreads. The lesson isn't don't buy ETFs. The lesson is know what your ETF is actually doing, because there is another hidden behavior that can surprise investors. Your ETF can change over time, not necessarily because the fund manager suddenly decided to gamble, but because the index itself can change. Companies enter, companies leave, weights change, sectors rise and fall. A fund that once felt like one thing can gradually become something different. Imagine Michael's father had bought a broad market ETF 20 years ago. At the time, the economy looked different. The biggest companies looked different. The dominant industries looked different. But his shares didn't come with a little message saying, "Your portfolio has evolved." The fund simply followed its rules, and that is both the strength and the strange feature of index investing. You don't have to constantly decide which companies should win. The rules do that for you. But that also means the rules can quietly reshape your exposure. And sometimes the biggest risk isn't what the ETF owns today, it's what you assume it owns. That brings us to the question investors should ask before buying any ETF. Not, has this ETF gone up? Not, does everyone own it? Not even, is the fee low? The better question is, what exactly am I buying? Because once you ask that question, the ETF stops looking like a ticker symbol. It starts looking like a system. And that system can have risks that aren't obvious from the performance chart, especially when the market gets emotional. Because the real test of an ETF isn't what it does when everything is calm. The real test comes when millions of investors suddenly want to do the same thing at once. And that's where the story gets much more interesting. Imagine a market morning when investors wake up frightened. News is everywhere. Stocks are moving quickly. People open their brokerage accounts. Some want to buy, others want to sell. And suddenly, the beautiful simplicity of just sell the ETF becomes a question of market mechanics. Who is standing on the other side? At what price? How wide is the spread? And what is happening to the underlying securities at the same time? ETFs have a mechanism involving market participants and the creation and redemption of shares that helps keep the ETF's market price connected to the value of its holdings. That mechanism is one reason ETFs can function so efficiently. But during stressed markets, trading conditions can change. Bid-ask spreads can widen. Underlying securities can become harder to price, and the price you see on the screen isn't necessarily the same as the value of every asset held inside the fund at that exact moment. The SEC specifically warns investors that ETF shares can trade at premiums or discounts to NAV, and that spreads can reduce returns. This is why the most dangerous misunderstanding about ETFs isn't necessarily that they are risky. It's that people sometimes assume they are simple. Some are, some aren't, and the difference can be enormous. Think about the example of Michael's grandfather. He had one basic rule: don't invest in something you don't understand. Michael used to think that rule was old-fashioned. Why read a prospectus when an ETF already has a simple name? But eventually, he realized his grandfather wasn't saying, understand every financial formula. He was saying, understand what you're trusting your money to do, and that's a much more powerful rule. If an ETF tracks a broad index, understand the index. If it focuses on one sector, understand the concentration. If it uses leverage, understand that the target may be daily. If it uses options, understand that the strategy can behave differently from simply owning stocks. If it invests internationally, understand currency and market risks. If it holds bonds, understand interest rate and credit risk. If it has a narrow theme, understand that a theme is not the same thing as diversification. And if you're comparing several ETFs, look underneath the labels. You may discover overlap you never expected. You may discover that your 5 investments are heavily connected. You may discover that the cheapest looking fund still has trading costs. Or you may discover something reassuring, that the ETF actually does exactly what you wanted. That's the important point. The goal isn't to become afraid of ETFs. The goal is to stop treating every ETF as if it were the same kind of investment. Because an ETF is a container, what's inside the container matters. And there is one final psychological trap worth remembering. Performance. When an ETF has gone up dramatically, Investors naturally want to know whether they missed their chance. The chart creates urgency, the name creates excitement, and the recent return creates confidence. But past performance doesn't tell you what the fund will do next. Investor.gov explicitly warns that past performance is not a reliable predictor of future returns. That's easy to understand intellectually. It's much harder to follow emotionally. Because when your neighbor tells you about the ETF that doubled and your friend shows you their account, when financial videos constantly highlight the biggest winners, your brain starts asking a different question. Why don't I own that? That's how investing can quietly shift from building a plan to chasing a story. And sometimes the most expensive thing inside an investment isn't the expense ratio. It's a decision you made because you didn't understand what you were buying. So, if you own ETFs, the next step doesn't have to be complicated. Open the fund's information, look at what it actually holds. Look at its objective, look at the risks, look at its expenses, look at its historical premium or discount information where available. Look at its bid-ask spread. And if you own several ETFs, compare their holdings, not just their names, not just their logos, not just their past returns, their actual exposure. Because your portfolio is the combination of what you own, not the names you gave each piece. And that brings us back to Michael sitting at his kitchen table. He started with a simple goal: build wealth without spending his life picking stocks. He didn't need to abandon ETFs. He didn't need to become a professional trader. He simply needed to understand what he owned. The biggest surprise wasn't that ETFs had hidden tricks. It was that there were no tricks at all. The information was there. The strategy was there. The risks were there. He just hadn't looked closely enough. And maybe that's the real lesson. An ETF can be one of the simplest tools in investing, but simple to buy doesn't always mean simple to understand. Your ETF may be overlapping with other funds. It may be more concentrated than you realized. Its price may temporarily differ from the value of its holdings. Its trading spread may quietly affect your returns. And if it's designed around leverage or another specialized strategy, its behavior may be very different from what its recent chart suggests. None of that means you should panic. It means you should know what you're holding, because the strongest investor isn't the person who owns the most complicated portfolio. It's the person who understands why every piece is there. Your money doesn't know what the ETF is called. It only experiences what the ETF actually owns, how that strategy behaves, and how it fits into the rest of your financial life. So before you buy another ETF, because its name sounds smart, before you add another fund, because its recent return looks impressive, take a moment, open the holdings, read the objective, understand the mechanism, and ask one simple question: what is this investment actually doing with my money? That question may be worth more than another 100 hours of watching market predictions. Because sometimes the biggest investment mistake isn't buying the wrong thing. It's buying something you never really understood. If you want more documentaries about the hidden money decisions shaping America's financial future, subscribe to MSBT Finance.